I believe you are asking about tax rules related to trading, investment profits, and losses. Tax rules can vary based on your country of residence and its tax regulations. Here's a general overview of how taxes might apply to trading and investment activities. Capital gains tax. Many countries have a capital gains tax that applies to the profits made from selling investments like stocks, bonds, and real estate. The tax rate can vary depending on how long you held the investment, short-term versus long-term. Short-term gains are usually taxed at a higher rate than long-term gains. Losses deduction. In some tax systems, you can offset capital gains with capital losses. This means if you have losses from certain investments, you may be able to deduct those losses from your overall capital gains, potentially reducing your tax liability. Wash sale rule. Some countries have a wash sale rule that disallows claiming a loss on the sale of a security if you buy a substantially identical security shortly before or after the sale. This rule is designed to prevent people from selling securities at a loss for tax purposes while still maintaining the same investment exposure. Dividend and interest income. Profits from dividends and interest earned from investments are also typically subject to taxation. The tax rate may vary based on your overall income and the specific tax laws in your country. Trading frequency. Depending on how frequently you trade, you might be classified as an investor or a trader. Different tax rules could apply to each category. Traders might be subject to different tax treatment, including potential deductions for trading-related expenses. Retirement accounts. Some countries offer tax-advantaged retirement accounts, e.g., IRAs, 401ks, that allow you to invest without immediate taxation on profits. However, there are usually rules about when and how you can withdraw the money without penalties. Tax reporting. Properly reporting your trading and investment activities is crucial. You may need to keep detailed records of your transactions, including dates, amounts, and costs. Some countries also require specific forms or reporting mechanisms for investment-related income and losses. Seek professional advice. Tax laws can be complex and subject to change. It's recommended to consult a qualified tax professional or accountant who is familiar with the tax regulations in your country. They can provide personalized advice based on your individual. Of course, I can provide you with information and answer questions about the stock market. The stock market refers to a marketplace where shares or ownership in publicly traded companies are bought and sold. It serves as a platform for investors to trade stocks, which represent a fractional ownership in a company. Here are some key points about the stock market. Stock exchanges. Stock markets operate through stock exchanges, which are physical or virtual platforms where buyers and sellers meet to trade stocks. Some well-known stock exchanges include the New York Stock Exchange, NYSE, NASDAQ, London Stock Exchange, LSE, and Tokyo Stock Exchange, ZE. Stock indices. Stock indices are used to track the performance of a group of stocks. They provide an overall snapshot of the market's health. Examples of indices include the S&P 500, Dow Jones Industrial Average, DJIA, and the Nasdaq Composite. Stock price fluctuations. Stock prices can fluctuate due to a variety of factors, including company performance, economic indicators, geopolitical events, interest rates, and market sentiment. Investing and trading. Investors can buy stocks to hold for the long term, hoping for capital appreciation and dividends. Traders, on the other hand, aim to profit from short-term price movements. Different strategies and approaches are used for investing and trading. Risks and rewards. Investing in the stock market offers the potential for significant returns, but it also involves risks. The value of stocks can go up or down, and there's no guarantee of profit. Diversification and research are important tools for managing risk. Types of stocks. There are various types of stocks, including common stocks, which offer ownership and voting rights, and preferred stocks, which offer priority in dividends but may have limited voting rights. Market participants. The stock market involves various participants, such as individual investors, institutional investors, like mutual funds and pension funds, traders, and market makers. Initial public offerings, IPOs. When a private company goes public and offers its shares to the general public for the first time, it's called an IPO. Investors can buy shares of the company during the IPO process. Bull and bear markets. A bull market is characterized by a prolonged period of rising stock prices, while a bear market sees prolonged declines. These market cycles are influenced by economic factors, investor sentiment. Profiting from trading, whether it's in stocks, cryptocurrencies, forex, or any other asset, requires a combination of knowledge, skill, discipline, and risk management. Here are some key principles to consider if you're looking to make a profit from trading. Education. Gain a solid understanding of the market you're trading in. Learn about the asset's fundamentals, market trends, technical analysis, and any relevant news that could impact prices. Trading strategy. Develop a clear and well-defined trading strategy. This could involve day trading, swing trading, trend following, or other approaches. Your strategy should outline when to enter a trade, when to exit, and how much you're willing to risk on each trade. Risk management. One of the most crucial aspects of trading is managing risk. Only risk a small portion of your total trading capital on each trade. This helps protect your overall portfolio from significant losses. Stop-loss orders. Implement stop-loss orders to automatically exit a trade if the price moves against you. This can help limit your losses and prevent emotional decision-making. Technical analysis. Learn how to read and interpret technical indicators and charts. Technical analysis can provide insights into potential price movements and entry/exit points. Fundamental analysis. For longer-term trades, especially in stocks, understanding the fundamental health of the underlying company is essential. Study financial statements, earnings reports, and industry trends. Emotional control. Emotional decisions can lead to poor trading outcomes. Maintain discipline and stick to your trading plan even when the market is volatile. Practice with a demo account. If you're new to trading, consider practicing with a demo account. This allows you to gain experience and test your strategies without risking real money. Stay informed. Stay up to date with market news and events that could impact the assets you're trading. This information can help you make more informed decisions. Continuous learning. Markets evolve, and trading strategies that work in one environment may not work in another. Continuously educate yourself and adapt your strategies as needed. Understand leverage. If trading with leverage, borrowed funds, understand the risks involved. While leverage can amplify profits, it can also lead to significant losses. Patience and realistic expectations. Trading success doesn't happen overnight. It takes time to develop skills. I can provide you with some general tips regarding stock market investing, but please keep in mind that investing in the stock market involves risk and there are no guarantees of profits. Always do your own research and consider consulting with a financial advisor before making investment decisions. Here are some tips to consider. Diversify your portfolio. Don't put all your eggs in one basket. Diversification involves spreading your investments across different sectors, industries, and asset classes to reduce the impact of a single loss. Long-term perspective. Stock market investing is best suited for the long term. Trying to time the market or make short-term gains can be risky. Focus on the long-term growth potential of your investments. Research and education. Understand the companies you're investing in. Research their financial health, business model, competitive advantages, and industry trends. Stay informed about the broader economic and market conditions as well. Risk tolerance. Assess your risk tolerance before investing. Different investments carry different levels of risk. Make sure your investment choices align with your comfort level for risk. Avoid emotional trading. Emotional decisions can lead to impulsive buying or selling. Stick to your investment strategy and avoid making decisions based on fear or greed. Stay patient. Stock prices can be volatile in the short term. Stay patient and avoid making knee-jerk reactions based on temporary fluctuations. Dollar cost averaging. Consider using a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This can help reduce the impact of market volatility on your overall investment. Keep cash reserves. It's a good idea to keep some cash reserves for emergencies or opportunities. This can prevent you from needing to sell investments during a downturn. Avoid chasing trends. Just because a stock is popular or has seen recent gains doesn't necessarily mean it's a good investment. Do your own research and avoid following investment fads. Review and adjust. Regularly review your investment portfolio and make adjustments as needed. As your financial situation and goals change, your investment strategy may need to adapt as well. Consider professional advice. If you're unsure about your investment decisions, consider consulting a financial advisor. They can provide personalized guidance based on your individual circumstances. Remember, diversification. Spread your investments across different industries, sectors, and asset classes. Diversification can help mitigate risks by reducing the impact of poor performance in any one investment. Long-term perspective. The stock market can be volatile in the short term, but historically, it tends to rise over the long term. Focus on your long-term investment goals rather than short-term fluctuations. Research and education. Understand the companies you're investing in. Conduct thorough research on their financials, industry trends, competitive landscape, and growth potential. Risk tolerance. Assess your risk tolerance before investing. Be honest with yourself about how much risk you're comfortable taking on, as this will influence your investment decisions. Avoid emotional trading. Emotional decisions often lead to poor outcomes. Avoid making impulsive decisions based on fear or excitement. Stick to your strategy. Regular review. Periodically review your portfolio to ensure it aligns with your goals. Rebalance if necessary to maintain your desired asset allocation. Stay informed. Keep up with market news and developments, but don't let short-term headlines dictate your investment choices. Focus on the bigger picture. Dollar cost averaging. Invest a fixed amount of money at regular intervals, e.g., monthly, regardless of market conditions. This strategy can help reduce the impact of market volatility on your investments. Emergency fund. Before investing, ensure you have an emergency fund with several months' worth of living expenses. This provides a safety net and prevents you from selling investments during downturns. Professional advice. Consider consulting with a financial advisor or investment professional. They can provide personalized guidance based on your financial situation and goals. Avoid timing the market. Trying to predict market movements and time your investments can be risky. Even experienced professionals struggle with this. Focus on a consistent, disciplined investment approach. Learn from mistakes. If you do make investment mistakes, learn from them. Don't dwell on losses but use them as opportunities to improve your strategy. Reassess regularly. Your financial situation, goals, and risk tolerance may change over time. Regularly reassess your investment strategy to ensure it remains aligned with your objectives. Remember, there's no foolproof way to eliminate all risks from investing, but by following these tips and diversification. Spread your investments across different industries, sectors, and asset classes. Diversification can help mitigate risks by reducing the impact of poor performance in any one investment. Long-term perspective. The stock market can be volatile in the short term, but historically, it tends to rise over the long term. Focus on your long-term investment goals rather than short-term fluctuations. Research and education. Understand the companies you're investing in.